What do you think? Yeah, thumbs up. I don't know what that means. Break or keep going?
Break.
Break. Okay. Jade says we can continue. Kyle is okay with powering through, but Natasha wants a break. 2 to 1, we seem to want to carry on. Will you be okay, Natasha, if I just carried on?
Yeah, that's fine.
I'll speed up. I'll speed up. Okay. I'll not digress into other areas. All right. Let's carry on then. Earnings management. Okay, there's a few learning objectives that we will look at in details as we talk about the slide. So what the hell is earnings management? It is basically the managers of the company, CEO, CFO, typically the CFO working in tandem or on the instructions of the CEO that end up choosing certain accounting policies or real actions to uh, achieve certain objective. And with regards to the earnings numbers, right? So we are talking about managing the earnings number. It's ultimately net income that will drive the EPS number. So you're taking certain choices, making certain choices about either accounting policies or taking certain specific action that will help achieve that objective. And the objective, of course, if you're looking to manage the earnings, could be either to report more earnings or than otherwise would be. So increased reported earnings than unmanaged numbers would be. Or you can find that there could be the other way around. You want to reduce the reported earnings. So specific act of earnings management can be studied by analyzing accruals, right? So there's accruals that occur over which managers have some say. So think about setting up the allowance for doubtful accounts, the allowance for inventory, uh, these or even depreciation numbers, choices with regards to useful lives and so on, that can then have a cascade effect in terms of reported numbers, right? If I want to increase my reported net income, I want to reduce the expense. So to reduce bad debt expense, I might make a choice of lowering the requirement of the provision for doubtful account, and that can help achieve my target. There is evidence that managers do take actions like this. They do engage in discernible patterns of earnings management. We'll talk about those patterns in a bit. But before that, why? Why would managers want to manage reported earnings? And well, the first one is they're looking to maximize their bonuses, right? To uphold, enhance their own personal interests. It could be because they feel pressured to meet investors' expectations about earnings. If they don't meet the expectations, that's going to have a negative impact on stock price, and then their jobs could be on the line, or their financial well-being could be on the line, or they have these loan covenants. See, we talked about economic consequences of accounting policy choices. Even though you don't have a cash flow impact, accounting policy choices do have economic consequences. And one such consequence is that if my earnings number goes down, it will affect my debt to equity ratio. And if that happens, I could be in violation of a debt covenant that said your debt to equity ratio cannot go above a certain level. And the consequence of that could be my interest rate that I'm charged goes up. And that then has real consequences for me as a company. So I'm trying to avoid the economic consequences arising from that. Uh, we could be a private company looking to go public. So for the IPO, we want to put the best impression of our company so that we are able to raise the maximum amount of money from the public. So that could be a reason for engaging in earnings management. Sometimes we just feel the heat. So retailers right now are being, sort of questioned heavily. The media has got reports about how Loblaws earned obscene $500 million plus of net income at a time when hard-earning and hardworking Canadians are struggling, to bring food, healthy food, etc. You see those kinds of stories. So, the companies might just want to avoid that media glare at themselves. So, in order to reduce political visibility, maybe they will just try to reduce their earnings number. I mean, let's not our net income number could be higher than what we state, but we just want to stay under the radar. So, just to avoid the political visibility, they might try to report lower earnings than possible or to influence government policy, right? So they want government to act in a certain way. Uh, they want, let's say, Canada, we have a supply management for the dairy industry, right? The U.S. has been trying to convince Canada to remove that particular policy management, so that then companies or agribusinesses from the U.S. can start selling U.S. produced milk and dairy products in Canada. And their argument is that your prices in Canada are too high. The customers in Canada will benefit if you let us move in. The flip side of that argument is that, it could also mean that the Canadian dairy industry could be wiped out in the face of the competition from the US. And the US also provides a lot of agricultural subsidies. So their prices are low, maybe for a reason, because of the huge subsidies that their businesses get. So, in order to influence government policy like that, maybe at times, the producers might sort of show, oh, we are bleeding here, we're not making money. Um, and so, therefore, we need to bump up our price by so much or whatever, right? Whatever outcome you want to get, if you want to show that you are being the victim right now, reduce your reported earnings, and that can you want competition from some place to be stopped, or you want the government to impose a tariff, show that you're suffering from as a in the face of competition from that particular country, that there is an undue dumping happening by that country, and so you'll get these retaliatory tariffs and so on. Or there could be a desire to nod, wink, wink at investors without explicitly spelling out certain piece of information. So to communicate blocked inside information to investors. You will learn a little bit more later when we talk about the incentives for voluntary information production in a later chapter. Right now, I'm not going into any details here, but there can be an opportunity to signal to markets without actually explicitly stating what's there. Now, some of these objectives you can argue are good because they help in efficient contracting, and the others are opportunistic. They only serve the interests of the manager. We talked about earnings management happening in discernible patterns. There are four main patterns. One is taking a bath. It's a very extreme form of earnings minimization. So earnings minimization and taking a bath are similar, except that taking a bath, you're talking about taking a huge write down so that you are reporting the lowest possible earnings number. You're kind of doing a cleanup so that the result would be that in the next year or the following years, our earnings number would be much higher than they otherwise would be. So this is usually when companies will take impairment losses and all the way. You're just cleaning up the books so that in future years, depreciation expense is lower and net income will be healthier than it otherwise would be. So generally that happens when it's very clear that our earnings numbers are going to be below the bogey. Remember we talked about bogey and cap? Bogey is where that's the minimum income that the company has to earn before the managers receive a bonus. If as a manager, I know that I'm going to miss my bonus this year because my earnings numbers are not going to be high enough, and there's no way that I can pump up the earnings number to go above the bogey, then this would be the year to take a bright royal bath, clean up house, right? Take all kinds of losses this year, and you can blame it on something, right? You can blame it on something that you would argue was beyond your control: inflation, supply chain issues. Think about whatever. And then next year onwards, your earnings numbers will be high. Earnings minimization is a little bit, well, you're still trying to report lower earnings, but here it's not as severe as taking a bath. So, this, if you kind of look at the other end, if the company is doing so well that the profit is fairly high, but now we are possibly expecting that the bonus cap might be exceeded. Remember, the cap is the maximum beyond which no bonuses will be paid. So let's put some money in the bank. Let's lower the earnings number to as much as possible. And so what's going to happen? We are going to use accruals, right? So accruals, if I'm reducing earnings, I'm going to be increasing certain expenses today, setting up some provisions or liabilities. Next year, if those expenses don't occur, I'm just going to reverse the provision, right? And that's going to cause that the reversal of the provision will increase my next year's reported income. So next year I'll have a higher chance of receiving a bonus. So you're trying to play around with the earnings number. You're reducing the earnings this year so that you have a better chance of reporting higher earnings next year. Taking a bath, same idea, but possibly different reasons for taking that action. You'll take a bath when you know things are dire, right? You take a massive, massive reduction of earnings when you know that things are bad. If things are not that bad, usually managers will try to increase reported earnings because higher the earnings, higher will be the bonuses received, as well as the greater protection we have against violating debt covenant. So over here, if you see the patterns, either report earnings more than they should be, less than they should be, that's your earnings minimization, or a very extreme form of reducing earnings that actually involves a lot of impairment losses, etc., that will set up um, the company for stellar earning performance in future years. There's one last pattern, and that is of earnings smoothing. So this happens when companies, are otherwise exposed to or net income numbers being very high one year and lower the other year. Volatility in reported earnings. Volatility is measured in terms of standard deviation. So compared to an average earnings number, the standard deviation that the company has, the greater the standard deviation, the more risky the company is seen. And greater risk comes with higher requirements of rate of return, which then have an impact on the stock prices. So what managers of companies that look to smooth earnings do is they're doing it for two things. One, to reduce the overall perception of the company's riskiness. And the other one, if let's say they are at a point where they are making a bonus, right? If they are earning a bonus, but there's a chance that next year's net income could be lower. By smoothing out the earnings number, you want to stay within the lane, right? You have the bogey on one end. Below the bogey, you're never not going to receive a bonus. You have got the cap at the other end. Beyond the cap, you don't get the bonus. But if you're already in that lane, in that sweet spot between the bogey and the cap, and you're getting paid your bonuses, You want to make sure that you stay there. So make sure that your earnings numbers are smoothed out and there's no wide, jerky movements. So the amount of bonuses that you get are fairly stable as well. If the income is smooth, your amount of bonuses will also be fairly smooth. All right. So using accruals to manage earnings was first studied by, I think his name is Paul Healy in 1985 as a part of his PhD thesis. So in positive accounting theory, there's a bonus plan hypothesis, which states that if a company has a bonus plan in place, other things remaining equal, managers will choose accounting policies that will help report higher net income than otherwise. So in his study, Healy looked at the bonus plan hypothesis, and what he showed is that companies actually do manage earnings through the use of discretionary accruals. Now, a problem is to get a good estimate of what discretionary accruals are. So what Healy did was pretty simple, yet, in hindsight, very elegant. He said, you know what, net income, if I look at net income, it's basically my cash flow from operations. And then I could have either income increasing accruals or income reducing accruals. If I compare net income to cash flow from operations, if my net income was 100 and my cash flow from accruals was 120, then the impact of the accruals, the changes in non-cash working capital and the non-cash items like add back depreciation, add back losses, subtract the gains, etc., was due to an increasing component of accruals. And if let's say if my income was 100 and my cash flow was 80, then um, sorry, the other one would have been an income decreasing compared to my cash flow. And in the next one, if my cash flow was less than my net income, then the accruals were income increasing. Because ultimately, net income should correlate as much as possible to cash flow from operation. So what he did is then he split up, as I said, split up the net income into those two components, cash flow from operations and then plus or minus net accruals. He then um, okay, what he did was okay, I'm not going into a description here. I'm talking about how determining discretionary from non-discretionary can be difficult because you got to work through the balance sheet item and the cash flow item by item. You got to use total accruals as a proxy. You got to pick up a specific account to figure out whether you have evidence of accruals. So what Healy did is he actually used the Jones model. And Jones model uses a regression equation to figure out the non-discretionary part while keeping constant, controlling for the level of business activity. So I'm not going to get into the details here, but anyways, you don't even need to worry about how he did it. But the key takeaway is that his results support the bonus plan hypothesis. The Jones model, in case you're interested, is here in this slide. I'm not even going to try to explain it. It's regressing total assets to the change in revenues and the property, plant, and equipment. And then step two, you look at the error term or the difference between the total assets and what you get from the regression. And the epsilon is an error term. And with this, you are able to get the amount of discretionary accruals. And then what our friend Paul Healy found, was that companies do actually engage in earnings management. It's a very beautiful paper. In case you're ever interested in reading about it. But bottom line for us is yes, someone studied the facts and they concluded that managers are up to some shenanigans when it comes to massaging the reported numbers, which is good or bad depending on your outcome, on your worldview. But there is a problem with what we call the iron law of accruals. And that iron law is that if I increase, like if I am aggressive in revenue recognition, right? So, I mean, what's an example of using an accrual? Let's say I want to increase my reported net income. And I say, okay, I'm going to try to be aggressive with revenue recognition. So, revenue that should otherwise have been reported next year, I'm going to record as revenue this year. Okay, what will happen next year? If you recorded next year's revenue in the current year, right? So 2024 revenue, if you report in 2023, 2024, you will have less revenue to report. Accruals reverse, right? The effect of accruals reverse. So if a manager is using discretionary accruals to manage reported net income, they're going to find it very hard. They're going to have to do it again, right? So if they increase current year's revenue by 10 million by reporting this year $10 million of revenues that are going to happen next year. Well, first of all, next year they will have to make up for the $10 million shortfall. And if next year they again want to increase reported earnings and reported revenue, they'll have to then borrow more revenues from their next year. So it's almost like the Red Queen effect. In order to stay at the same level, it's like running on a treadmill, right? If you're on a treadmill, in order to stay at the same spot, you have to run. And the more you engage in these discretionary accruals, the harder you'll have to keep finding additional discretionary accruals. And there'll come a point where you can't. You just can't, right? There's only so much of uh, earnings that you can move or revenues that you can move from the future today, which, I mean, in a way, Enron found, right? That was part of the debacle, reason of the debacle at Enron. So if managers continues to go very, very, very rapidly with income increasing or income decreasing, uh, what ends up happening sometimes with income decreasing, you find a way to put money in the bank. It's called cookie jar accounting. So if I reduce earnings today by increasing reported expenses, I will not have those expenses to report in the following years, and therefore my earnings will be higher next year. So that too has happened. That too, there is evidence that the management sometimes does that as well. It's called cookie jar accounting. You're putting some extra earnings from the current year into the future. Um, but what is problematic is then this distorts the picture for the investors. Because what managers are doing is they are massaging earnings numbers by moving around amounts from one period to another, but these amounts are low persistence. They don't repeat in the following year. So the fact that accruals reverse means they are low persistent items. And investors often are not able to distinguish between high persistence items that will continue in the future versus that wouldn't. So if you recall, we had looked at a case many, many, many classes ago about IBM, right? IBM had reported an increase in earnings, and what they had done was that there was a one-time gain from the sale of assets that they had tried to pass off as a permanent reduction in operating costs. Permanent reduction in operating costs is a high persistence item, whereas a one-time gain is low persistence item. And if you recall, they got rap on their knuckles, and their stock price fell in response because people were not happy that they were trying to pass off a one-time earnings number as if it was an ongoing reduction in operating earnings. Right? Investors get distracted, but managers feel tempted. Oh, let's just carry on using these low persistence um, accruals to somehow hoodwink um, investors. So as accountants, we want to watch out. We want don't want managers to keep increasing reported earnings because there is a limit to it. We also don't want managers to keep using income decreasing discretionary accruals either. So one way that we can help investors is by splitting the reporting of net income into income from continuing versus the other items. So if you kind of look at a multi-step income statement, you find other revenues and expenses because that's where your typical gains and losses, etc., are shown. The other revenues and expenses part is shown separate from the income from operations. And then we have a separate disclosure of income from continuing operations as well. So if you provide the amounts in under separate clusters, that that is one way that we can improve upon the investor's ability to identify core earnings from earnings that is impacted by accruals. Now, there is a real earnings management approach as well, which is different from accruals. Accruals is hard, you know, continue to manage earnings using accruals is hard. So managers have figured that out as well. And what happens here under real earnings management is that you actually start taking actions that will affect cash flows. Accruals don't affect cash flows, right? But real earnings management do achieve, they do have an impact on cash flows. And so some examples of that would be to reduce spending on research and development because that'll increase net income. Reduce selling general and administrative expenses because that'll increase reported and net income. And you might argue what's wrong with cutting back on costs, but if these are costs, let's say, if you reduce the salespeople's commissions, that's going to have an impact on their motivation. And if you reduce advertising, that's going to have an impact on sales, right? So yes, there's a cash flow impact from cutting back on your advertising now, but in the longer run, that's going to have nasty effects. Or you figure out when to dispose of long-lived assets and investment, right? So you pick up a year. So if you want to reduce the reported and income, um, or you're kind of in a bad spot, maybe sell off an investment, right? So sell off an investment, and that's going to have an impact on cash flow as well. And if you sold the investment for a gain, that's going to have an impact on reported net income. And then you can also engage in distorting prices to boost sales in the short run, right? So these uh, will put huge percentages off now. We'll get sales now, and that will boost our earnings for the current period. Or you overproduce, and what that does is it reduces your average cost per unit because the fixed cost is spread over a larger number of units, lowers your cost of goods sold expense now, but then you've got a whole bunch of unsold inventory. So what I'm trying to say here is that when you have real earnings management, it can have a very negative impact, significantly negative impact on future operating performance. Because real earnings management not only affects the company's financial numbers, but also its operations. And as a whole, can lower the value of the company because of the negative impact on future earnings and future cash. Yet we see managers are increasingly willing to engage in real earnings management. Reason? If they use accruals, the auditors will find it out, right? The auditors have become wise, and they will ask for adjustments. So real earnings management, you can, if someone asks you, how come you guys cut back on R&D? Oh, we were able to achieve, what's the word? Better synergies, this and that. You use the jargon to kind of say to just camouflage the whole thing. We cut back on R&D because it would have an impact on our cash flows and increase reported earnings in the short run. But you can always pass it off in other language. Relying on accruals also is risky because there are limits to how much you can manage earnings solely through accruals. Accrual based earnings management is almost done. Like, it's very rare to find on an ongoing basis evidence now, but from time to time companies will still do it, right? As a one off, you will still find companies do it. And in your accounting courses, you have probably been exposed to inventory errors, right? A lot of times those errors are not like accidental, right? Sometimes they're intentional. So what happens if my ending inventory is overstated? Well, if my ending inventory is overstated, my cost of goods sold is understated, and it will result in higher gross profit, higher net income. So we know that, and we probably read about that, and we learned the impact on financial statements. And we know that with inventory errors, they wash out in 2 years, right? The current year's higher inventory will become next year's higher beginning inventory, which means next year their cost of goods sold will be overstated. So net income for next year will be understated. That was the example of accruals reverse right there. Yeah. Do companies play with inventory? They do, right? They do. And as auditors, you will be asked to pay close attention to inventory because that is an area which is susceptible to manipulation. The other area that is susceptible is sales, right? So they will play around with sales. That is why when you're auditing revenue and accounts receivable, you will be paying very close attention to those because that's an area where companies can and do try to massage their numbers. So can we say earnings management can have any good, can produce any good? Well, it can help communicate blocked communication. Um, and what do we mean by blocked communication? Um, so if I'm trying to say to the markets, hey, good things are around the corner. If I'm a manager who plans on being around for the longer run, I've got a long decision horizon. I know that consistently using accruals for earnings management purposes is foolish because accruals reverse. So if I am willingly engaging in an act that uses accruals to achieve an increase in earnings, maybe what I'm trying to tell the markets is, hey, our earnings, our revenues are going to go up in the future. I know that maybe there is a very exciting new product that's coming our way. Now think about one way of accruals. So this is a bit of a digression, but it's apropos here. Think about research and development, R&D, right? The standards say research costs, they have to be expensed. If you're engaging in research, you need to expense it. Result of expense, the entire amount is subtracted from revenues, your net income is lower. If you capitalize development costs, you're not expensing the cost, okay, so your net income is higher. Now, if you were just capitalizing from the point of view of being able to report a higher net income, you know that if that development asset was not warranted, you'll have to do a write-off in the future, right? That development asset will have to be written off in the future. if it does not meet the definition of an asset, right? Admittedly, under IFRS, there are strict criteria that have to be met for us to capitalize development costs anyways. But it's also an indication that the company is very confident of its ability to complete the development project. It has an actual need or a market for the project. It's got actual resources. So, just for the people that are patient, good things will happen. You're trying to communicate that information through your deliberate act of earnings management. And this is what I was sort of comparing to, looking at someone and winking at them without really telling anything, winking or nodding. You're trying to pass some unspoken information, right? Now, what could enhance this is certain actual actions of skin in the game. And this is something that is tracked by market participants is if managers know, and managers do know more about the company than anybody can, if insiders are buying the stock, right? And if they're making credible purchases, not small amounts, if insiders are buying respectable chunks of a company's shares, if I'm the CEO and I'm putting in $2 million of my own money buying more shares, then either I'm an idiot or I know something that others don't, and I'm likely acting because I believe the company's stock price will go up in the future. And one reason for that could be maybe we are coming up with a great new product, maybe we are getting a super order that will increase our revenues. We don't know. There could be some information that is not yet public, but if insiders are acting on it, right, that could be a signal to the markets. So is there any evidence at all? Some research. Um, Bo and Rajgopal, their conclusion was that managers use accounting discretion to communicate their expectations about future firm performance. Now, if a manager is, let's say, reducing reported net income, maybe that is an indicator to the market that, hey, guys, tougher times are ahead. That is also, could be seen as a way of communicating that things are going to be tight. Smoothing applied can help um, investors in predicting future consistent earnings. And if investors feel that they are able to do a good job of predicting future performance, they'll become more confident in that company. They will continue to keep their investment in the company, maybe grow their investment in the company. And that should usually be correlated with higher stock prices and therefore better share returns. That's Tucker and Zarowin's conclusion. If a bank puts in unexpected amounts for loan loss provisions, um, yes, it indicates that there are problems, but the fact that the bank has booked the higher loan loss provision can also be seen as an indicator that the bank is trying to resolve their problems. But this is a really old paper, and I'll be very interested to hear from the group that's working on Silicon Valley Bank because that came out of nowhere. Hey, will be interesting to see if they were increasing their loan loss provisions at all early enough. And one last paper, consistent earnings patterns lead to more favorable judgments because people get more confident in future performance. And that's kind of linked with what Tucker and Zarowin had to say. Now, there is, of course, the ugly side of earnings management because that's where you see managers engaging these shenanigans so as to boost their bonuses, be able to sell their stock options at a higher price, or cookie jar accounting, as I mentioned. And that's the act of reducing income now so that you'll be able to reclaim it later on by reversing loan loss or any other provisions. And you find that such opportunistic earnings management is, relatively speaking, you compare international, it's more prevalent in countries that have less investor protection. What might be an example? Well, compared to North America, you could argue pretty much any other, except possibly for Europe. Any other country, think Russia, think India, they have relatively less investor protection laws. So you might see a lot more market making, market playing happening there. Is there more evidence? Companies do misstate earnings so as to get more cash from issuing stock, new shares. That was a conclusion by Dechow et al. Companies resort to real earnings management when analysts start issuing operating cash flow forecasts. So remember, operating cash flow you can't massage, right? Earnings, if you use accruals for earnings management, accruals don't have a cash flow impact. Accruals will affect net income, but not cash flow. So if analysts start providing forecasts about cash flows, then companies have no other option but to switch from accruals-based earnings management to cash, real earnings management. Take actions that will actually have an impact on cash flow than just the reported earnings. Hannah was the paper that showed cookie jar accounting. Managers resort to recording excessive provisions for low persistence special items to increase future earnings, reduce earnings today, but you increase future earnings. And if you think about how that happens, if a company writes off an impairment loss today, the depreciation in future will also go down because if an impairment loss is recorded, the total depreciable cost of the asset is also reduced, which then means less depreciation in the future. We are going to have less depreciation in the future. Everything else being the same, it means more net income in the future. Right? So that was a paper by Hannah, and that was vindicated by Bergstaller et al. When you have special items that cause the negative effect on income to this year, you will see in following periods income being higher. So a good question is, when we see evidence of managers engaging in earnings management, does that mean they believe that they can beat the market? And if they feel that they can beat the market by fooling the market, does that not mean that managers feel that markets are not efficient? Because if you go by the definition of an efficient market, by definition, no one should be able to beat the market. So that's a brilliant question. If we believe markets are efficient, then managers are certainly taking actions to make sure that what they are doing does not become publicly known. Because efficient markets, stock price reflects all information that is publicly available. Right? So if managers are engaging in earnings management, they're also taking actions to stop making information related to earnings management available in the public domain. And that's not good. So for us accountants, what we need to do, improve disclosure, right? That's tends to be the answer to pretty much all ills. What can we do as accountants? Improve the quality of information, provide note disclosure. Separate out the low persistence items from the continuing operation, etc., etc. That was all for this chapter, folks. So definitely shorter than the earlier one. What is now left for us is the last piece, and that's the accounting standards, the discussion of reporting standards. And that's the subject matter for chapters 12 and 13.